So this is where options were too expensive. And this is where options were not too expensive. Now, the interesting thing we want to look at is when we look at this study that was done from 2008 to 2019. So we've got everything from crashes all the way to incredibly low periods of volatility like we had from, say, 2013 to 18, 19. Very, very low volatility, very, very high volatility. So a little bit of both. So let's talk about what we're looking at here. So the green bars are where we had positive risk premium. So this is where options were too expensive. And this is where options were not too expensive. In fact, markets were moving at a much greater clip than options had implied. So this is really looking at, well, where were options priced and what was the subsequent next period of underlying volatility. And we can see that options were pricing this, and they were wrong by a massive amount in the global financial crisis. They underpriced what eventually happened, which completely makes sense. We had a massive, massive sell-off in those days, and it was prolonged. But then after that, we had volatility levels so high that even though markets were moving around, there was a positive risk premium. Positive risk premium doesn't necessarily have to do with the absolute level of volatility that's out there. It's just a relative calculation. Volatility can be very, very high, but if options are pricing in much higher movement, then you're going to have this positive benefit of this, we call that carry as well, this positive volatility risk premium. Options are just too expensive. So if the market's moving at a 20 and options are 30, priced at 30, it's positive premium. If the market's moving at a 35, but options are priced at a 50, if the VIX is 50, you can still make money selling the VIX because technically speaking, if you're able to isolate that volatility risk premium, you can make money.